I recently had an interview with Barron's about the financial alternative data market for one of their upcoming articles, and they asked a question which I felt would be important to cover in its entirety as it relates to the long term impact of alternative data on financial markets. I think this is a question that I've heard from both professionals who use alternative data, people who have looked at ticker trends in my business and have asked about the long term viability of what we're doing, and also just about alternative data markets in general from people who are coming into it and trying to figure out kind of what this is and how much of an edge this can give you in the long term. So, what this question is what is the viability of alternative data long term in terms of being able to provide an edge to certain market participants? And this is essentially what the reporter from Barron's was asking is, will eventually all of this data and information just become saturated into the market? And I felt that I had an interesting perspective on that, and that's what I wanted to share. If you're not familiar, my name is Adrian Navarre. I'm the CEO and founder of Ticker Trends. Ticker Trends is a financial alternative data business. We do a lot of really interesting things, both in terms of equity research, data tracking, KPI forecasting, raw data collection. If you're interested in anything as it relates to alternative data in financial markets, I'm confident that we have an offering that would fit your needs, or at least allow you to extract more alpha from markets in a way that I can virtually guarantee you no one else does, because I've now been in this industry long enough to see what other people are doing and how different we are. And it also shows in our track record and the research that we've put out and how it's anticipated many market moves on some of the largest billion-dollar equities in the world. So if you're interested in that, feel free to reach out to us, admin@tickertrends.io, or visit our website, tickertrends.io. But I'll get into what my opinion was on the long-term viability of alternative data and how I answered that question to the reporter from Barron's. So essentially how I started my answer is by first addressing what saturation of a specific data source actually looks like in financial markets. I think when people think of alternative data, a great example that I always use is credit card transaction data. Another example of this would be geolocation data. The reason being is because these data sources or these data points provide one conclusion. So when I'm looking at geolocation data and I see that the visits for Kava are rising year on year or month on month or week on week, then that tells me one outcome about the performance of the business that needs no additional information or context in order to determine. If I see that same store visits for Kava are rising or total visits for Kava are rising, then I can derive one outcome from that data point, and every person who's looking at that data will have the same outcome. The same goes with credit card transaction data. If transactions are rising for a certain product or brand or store or something like that, then all that's going to tell you is certain information about the profitability or revenue of that business. And it's essentially one outcome that you can derive from that data set. And everyone who's looking at that data set will gain the same conclusion. With these data sets, I do think, and obviously, there is an inherent level of saturation that comes of them in financial markets, because essentially once you start looking at the same data, everyone's looking at that data. There's a certain level of variability with it. For example, geolocation data is not an exact science. These companies like Placer.ai, they're estimating store visits, they're using a lot of machine learning models and spotty data and trying to build out trends with that. So there's no level of exact science in terms of there's not a company that actually has access to every single mobile phone in the world and puts like a geolocation product out based on that data. At least from what I know of, there's no perfect geolocation data set. So in the context of that, you could say that there's still a certain level of difference in how people can interpret the data, but broadly speaking, the conclusions are roughly the same from those data sets. And then maybe you have certain margin of error, certain variability across the data sets, where maybe there's a specific geolocation data set that's a little bit better, or a specific credit card transaction data that's better, or more larger coverage of different industries and types of people and panels of people from across the world. So within those data sets, there are things like that can still differentiate in how people can derive value and alpha from those data sets. However, the conclusions that come from them are all the same, and that means that there is, to a certain extent, a level of saturation that comes from it over time as more and more people just gain access to that information or data, or the information and data starts to leak to third-party sources and get priced into the market more broadly from a larger group of people than if just one fund or one firm had access to it. And then they could essentially just trade the market to derive all the alpha from that data set that no one else has access to. So broadly speaking, there is a certain level of saturation that comes of alternative data sets in the market where there's like one obvious derived outcome from that data set. What I told the Barron's reporter is, on the flip side, there are also data sets that I believe don't necessarily have a direct level of obvious saturation in the market. And let me explain where that comes from. So just as an example with ticker trends and what we do at my business is we're looking at a lot of unstructured data sets that don't have linear relationships to business performance. And what this means is that when we're deriving a conclusion from some of our data, to an extent, there can be like a linear relationship between, okay, web traffic is rising for a certain brand, and that means that revenue might increase from that. But very often, already with that statement, there's no level of certainty to that statement. If I'm looking at credit card transaction data, there's essentially a much more direct relationship between a rise in that data and the rise in the potential revenue of that business, assuming it's a good enough panel and large enough number of people that you're tracking with that credit card transaction. With web traffic, even if you had the most perfect data set in the entire world, you likely still would have variability and non-linear relationships between what's happening in how people are looking at that website and the revenue that actually translates to the quarter performance for that company. So what I'm trying to describe here is these data sets that we're analyzing and that we're tracking, to a certain extent, don't always have linear outcomes of performance to the business. Another example that I gave in the interview was the Duolingo controversy that happened recently that we wrote about, and we got exposure for it because we ended up being right about how the Duolingo business performance was slowing down due to some controversy around AI. And I think a great example of this is you could be a fund and you could look at that exact same data, for example, and build a thesis around how the Duolingo CEO's AI comments were giving more exposure to Duolingo, which would end up benefiting the business long term because of like this idea that all press is good press, right? So if a certain company gets a lot of exposure from media exposure, especially something like Duolingo, then that could lead to more downloads, more customers, more users on the app, more paid users. And that's an outcome that you could derive from looking at the same social data that we use to come to a different conclusion. So our conclusion was negative. However, hypothetically, it's possible that someone could come to a positive conclusion from looking at similar data. So these are data sets where I think there's less likelihood of a direct saturation of this information going into the market, because whenever you have to interpret information and whenever there's not a linear relationship between, okay, this value is rising, so the company is going to do well, whenever there's not relationships like that, and there's context and complex relationships and things happening in the data, that far significantly decreases the likelihood of there just being a direct saturation of that data in financial markets. Another great example of this that I also gave during the interview was the Victoria's Secret fashion show, which was another thing that we covered at Ticker Trends. And what happened during that event is there was something that had never happened in the history of Victoria's Secret, which was they had the fashion show when TikTok was a thing. Because prior to that, when Victoria's Secret had done their fashion shows, TikTok didn't exist. And so now you have this company that's bringing back the fashion show after many years. And this time that they do it, there are these new social media platforms, these new things that are popular. And this has never happened before. So there's no way for a quant firm or a mega fund, a pod at some firm to be able to look at that data and say, I know exactly how much revenue this TikTok trend is going to translate to for Victoria's Secret. Like every billion views that they get will translate to 50 million in incremental revenue. So since there's literally no history of this ever happening to the business before, there is not a linear or obvious answer outcome that will come of that data. So inherently, there's uncertainty and alpha and different strategies and methodologies and ideas that can come from that same piece of data in how it will be impacting the market. So essentially, my thesis here and what I'm trying to get at is, yes, some data sets can be more saturated in the market, especially more so when there are direct, obvious relationships between that data set and the performance of a business. When it comes to data sets that are not directly related to business performance, that is where the data set can have more uncertainty and a continued possibility of there being an edge in interpreting that data, if you can do it properly, because there's not inherently ever one single outcome that can come of analyzing that information or that data. And so that's why, what we do at Ticker Trends is we're taking this unstructured data and interpreting it into actionable insights for the customer. That's why we get paid. But that's also why our data and the methodology of what we do is different than some quant fund that's spending $50 million a year on a transaction data set and trading every 3 seconds based on every new credit card swipe that comes in from that data set. Obviously, I'm just making that up. But whenever you have those data sets that are just directly related to business performance, then you can do those things. But when you have a data set that's not directly related to business performance, then it's a much more complex process that can drive different outcomes depending on who's looking at it and how they use it. Just one more anecdotal story that I want to give. I've seen, and I'm not going to say specific things about what data set this was or who was using it, but I've seen quant funds that we've worked with in the past where they look at an unstructured data set and they have no clue how to interpret that data. And that's exactly what I'm describing. If I'm a quant and I can't just backtest some data point and say, when this goes up, revenue goes up, or when this thing happens, this direct other thing can happen with 100% certainty. Whenever the signal value becomes more complex than just a linear relationship, it's very difficult for these funds to consistently derive the information and value from those data sets, to the point where they might just not use them at all. So this is what I'm saying from the point of data set saturation. There's a lot of interesting things that can happen in data sets that are not just linearly correlated to business performance. And those are the alternative data sets that will not just get saturated away, even if alternative data goes to every single fund in the entire world, because everyone could still interpret it and understand it differently. Anyways, if you all have different opinions on this, I'd love to hear it. This is just my personal view on it from being in the industry, and I thought it was something interesting to bring up. I hope you at least got a new perspective on this. And again, I'd love to hear yours, and I'll see you in the next video.